Guys, 5 stocks have had huge gains in the last week, over double digits. First stock, DocuSign. Let's get into it now. DocuSign, I believe, skyrocketed because of talk of going private. Was that what it was?
Oh, that's what it was.
I think that's what it was. But look at this, guys. All-time high back in August of 2021 of $315. And after going up 13.57% in the last week,
nearly
40% in the last month, Mo, it's at $61 a share. That's still a drop of 80%.
Yeah.
Remember, we talked about this stuff. You got to look at the income statement here. This is a company that was growing like crazy. And then look what happened to this is the first 12-month period in which they had profit. And it was only $51 million. $51 million in profit on $12.5 billion market cap, $2.7 billion revenue. Now, Mo, look at this gross margin. 80% here.
Oh, and then look at the profit margin.
Yeah, it's just stinky. Now, is it growing and spending a lot of money to grow? Absolutely. And there's a great thesis behind that. They got to get users. But at the end of the day, I have one thing to say. First off, I love DocuSign.
It's a fantastic product.
I love it. I absolutely love it.
Mm-hmm.
So them going private, what does that mean? I don't know. I just look at this saying, how do you analyze this company? Maybe you base it on price to sales ratio. And you sit there and say, hey, other software businesses with 80% gross margin sell for 10 or 11 times price to sales. Great, could be the case. But this is a company that, would you be surprised if 5 years from now, Microsoft or Google or Apple didn't have some, or had some other
their own thing
that wiped them out?
Wouldn't be surprised.
I don't know, but I'm just sitting there saying, for me, it's just too early in the game. Let everything fall the way it falls.
Mm-hmm.
Stock number 2, Carvana, CVNA.
Still
this is a company
strong.
This is a company that was at $5 a share just a year ago. A year ago, it was $3.62 per share. Mo, didn't you tell me to buy it on December 28th, 2022?
I did, and you didn't listen, as usual.
It's at $55 a share right now, up 6% today.
Look at this all-time high.
Yeah, all-time high of $376.
Crazy.
If you're going to tell me right now that if you believed in Carvana and you wrote it all the way down, that you're going to sit there and just go, no, I still believe in it. Come on, give me a break. So, car dealership, essentially 13.5% gross margin. That's pretty sick. The price to sales ratio isn't awful with this low gross margin. It's basically, they're selling like a car dealership, a car manufacturer, I mean. No free cash flow in the last 5 years, no net income, no free cash. And the 5-year free cash flow is worse than their 5-year net income. But they're probably growing a lot of those towers, right?
Yeah.
That's probably a big reason why their free cash flow is so low.
Look at their shares outstanding.
Jesus Christ.
That's unbelievable. I haven't seen something this bad
15 million in 2016 to 110 million. And with dilution to guys, even if the business 10x, you've barely seen any growth from that because they've taken their shares up 7.5 times.
Wow.
7.5 times. Let me explain that for you. If there are 10 shares outstanding and you own one, you own 10% of the business. If they increase those 10 shares outstanding, not through splits, issuing shares for money, to 75, you still own one share, but now it's out of 75 other shares. You own 1.3% of the business. You went from 10% to 1.3 by being a dedicated shareholder. Does that sound like a company that cares for their investors?
Not at all.
Company number 3, Zillow. Let's look up Zillow. We all go to Zillow. We all see what the property value of our homes are. $13 billion.
Another one.
Yeah, but good news. They are showing free cash flow in the last 5 years, even though their net income is not. Okay. Another 80% gross margin. How do they even generate fees? I don't know how they generate fees. Probably through realtors and things like that.
Stuff,
referrals.
Or you list your home for rent or for sale by owner.
And on-demand experience with selling, buying, renting.
All-time high, $208 a share back in 2021.
And the low, also on December 28th of last year, $31. And now they're at $56 year to date, up 66% year to date, Mo. 45% of that in the last 1 month, 23% in the last week.
Again, shares, 121 million back in 2014. Today, 230 million.
So almost doubling. Not as bad as Carvana. So Zillow doesn't hate their investors as much. Guys, there's 2 ways to fund a business: debt or equity. And in order to fund it through equity, you got to issue shares, bring other shareholders in. Very standard. But it hurts I was thinking about it the other day. The reason I'm not very active in this startup community is I always tell people I want no dilution. They're like, well, we got to be I'm like, nope. If I'm buying in at 1%, I'm always going to own 1%. I don't want to be diluted. And that's a very tough thing in the startup world. Most people wouldn't agree to that. So Zillow. I think Zillow has some staying power though, Mo.
Oh, I agree. It's basically them and realtor.com.
Yep.
You know,
and look at this revenue, Mo. 300, 570, 780, a billion, billion two, 2.1, 3.5, 3.9 to 1.9.
coming back to reality.
Wow. Big.
Where do they kind of stabilize?
I don't know. And they've lost money every single year. Let's look at their free cash flow. One big year of 4 billion.
What year was that?
To the year ending September 2022.
Okay.
In fact, in COVID year, they lost 3 billion in free cash flow.
Wow.
8 pillars are sick.
Yeah,
2
they're really
checks.
nice.
Listen, this is a prime example of a company that's growing and growing and growing. The question is, can you tag along for the ride and hope they don't dilute you as the company grows its revenue and then eventually gets, because guess what? This gross margin is awesome. 80%. This is clearly probably losing money because of growth.
I'll give them credit. Since 2021 and year ending 2021, they have bought back shares.
Interesting.
Yeah. So
Okay.
I'll give them credit there.
All right.
I mean,
So great company, great service. The question is the stock reasonable for 7 times price to sales? I don't know. That's what I look at when I'm trying to when I'm trying to compare companies that don't make money. Look at their price to sales.
that's kind of the themes right here so far. Well, I don't know about Carvana, but DocuSign and Zillow, great product, great service.
I like Carvana service.
Yeah.
Yeah, you don't?
I don't know. I've never used it.
I haven't either, but I like the idea of it.
Oh, the concept's good, but
Yeah.
who knows if it's a good product?
Align Technologies. What do they do?
Is this the Invisalign?
Yep. You did Invisalign, didn't you, Mo?
Yeah, they're good.
You liked it?
Yeah.
Great. Controlling over 90% of the market. Wow. They've been around since 1998. Wow, that's
I didn't know
interesting.
that. Wow.
Big margin, 70% gross margin, 5-year profit margin of 23.6%, but last year only 9.5. Their last year free cash flow was 686. Last year's net income 362, but 5-year free cash flow was lower than the 5-year net income. That's interesting. Very big 5-year return on invested capital, 13%. All right, let's look at their income statement. Okay, sales are starting to drop just a little bit. Let's look at quarterly. What's Smile Direct Club? I just went out of business.
No way.
Yeah, you didn't hear that?
No. They're like, my God. I mean, from what I saw, they do the same thing, but you could kind of do it on your own. Like you would take the mold of your own teeth, send it back to them. You could buy it at like Walgreens.
Yeah, they closed. They're done.
Wow.
Interesting.
That was a big lawsuit that was going on between those two back in 2020.
Really?
Yeah.
So let's look at the quarterly revenue for Align Technologies. So 960 last quarter, the same quarter previous year, 890. A billion in June versus 970. So they're still, this is their first, their last, okay, they're back to growing, albeit not huge. Let's see what analysts are saying. Oh, wow, look at that. $9 a share in profit this year, going to $16.50 in 2027. Again, it's analysts and they have major problems with the future. Revenue growth, okay, reasonable. I think we should do a stock analyzer on this one.
This is a crazy stat right here. In 2022, Invisalign treated over 2 million cases, or roughly 10% of orthodontic cases for the year.
Wow.
That's nuts.
Guys, so we have this community. We have the software. If you're interested in learning more about it, go to everythingmoney.com. We're offering a free 7-day full access free trial. I'm not asking you to make a financial investment today. I'm just asking you to make an informed decision. So go to everythingmoney.com and check out our 7-day full access free trial. Now, Mo,
Yeah.
give me some numbers on 10-year growth rates, revenue growth for Invisalign. I want to make note of this. Look at this, by the way, Mo. A decline in its ROIC.
Oh boy.
Yeah. But anyways, revenue growth.
How about like 2, 8, and 14?
Oh, wow.
Is that, I mean, I can't really tell where they're going to finish. You know what I mean?
So the only
So I
thing I
kinda
have is it's 10% of the market, and I think that'll grow. Okay, 2, 8. We do 2, 7, and 12.
Sure.
Okay. Profit margin. 1 year. Clearly, this is an outlier.
Yeah.
Right?
Yeah.
So give me a profit margin number.
I previously had 16, 19, and 22, but I think I'm going to move that to like 18,
Love it.
21, and 24.
That's exactly what I was thinking.
Yeah.
Now look at their free cash flow. Very
Very
consistent at the
consistent.
18 mark. Very
We just
consistent.
put 18% across.
I'm going to do 16, 18, and 20 because pretty good gross margin. And as they take more and more market share, you got to think they can probably increase their free cash flow.
Okay.
Now, what earnings and free cash flow multiple are you assigning to this business at the end of the day?
13, 16, and 19.
That's exactly what I was thinking, Mo. Now, guys, for those of you who might be confused by this, it's a new company. If this was a mature big company, there'd probably be higher multiples. But it's a new company. It could go either way. I think they're gaining market share and they do a great. Everybody I know who's had Invisalign has absolutely loved it. Yeah. So I still want to be a little conservative on the low side on the 13 and give them a little premium on the high side. Guys, that's the great thing about the software here. You can make your own assumptions and decide for yourself what the right number is. Now, Mo, desired return, your margin of safety. What return do you want based on all of these
I
assumptions?
think I'm going to go 13, 15, and 17.
Okay. Can I modify just a little bit?
Yeah.
12 and a half, 15, and 17 and a half.
Okay.
So guys, what we're basically saying here is as our assumptions go up, we want a higher desired return, which is basically giving our margin of safety because the higher return, the lower the price. I hit the analyze button. The stock's currently at 260. Okay. We have a low price of 85 to 95, high price of 185 to 225, middle price of 125 to 150.
Yeah.
All right. So it's got to fall quite a bit.
A lot. Yeah.
And these are just math. Now, granted, we put in 15% return for the middle, but I think that's reasonable for a company like this. Well, probably not, but that's okay.
Here, even at 10% across the board for margin of safety. Look where we are.
Yep. Okay, next stock, guys, Enphase. Enphase Energy, hot stock. This year, down 51%.
Really?
But in the last month, up 25%. In the last week, up 19%.
This seems not volatile.
All-time high of 340, low. That was in December of 2022, just a year ago. And it recently hit its 52-week low of $73 a share. It's at 123. Yeah, this is solar generation, storage, community, all this thing. This is a hot business now, a hot industry. Remember, when industries come out hot, look at EV, look at crypto, look at there's a lot of volatility as people try to get market share. So let's say
you have to have a stomach and balls of steel to hold this thing.
Yeah.
Oh my God.
Look at its revenue. This is what's weird, Mo. 10 years, 305, 396, 297, 297, 303, 506, 700, $1 billion, 2 billion, 2.7. Big time growth. Big time growth. Were they able to make a lot of money off that? They went from losing money to making money consistently. Good for them.
Their cash flow followed that same trajectory, basically.
And the good news is their free cash flow is higher than their net income. Guys, we like looking at that a lot. And look at the debt. Market cap of 16.7, enterprise value of 17.7, very low debt. This difference here, guys, is essentially the net debt in the company. So very low debt in the company.
Now, let's look at the shares outstanding. Well, that is quite the increase.
So we're looking at the 8 pillars here, Mo. Like you said, 33%. That's the X I don't like here. I can get around these multiples by saying, hey, it's growing fast. This is happening thing. But when you're growing fast and issuing a lot of shares, even though they're cash flow positive, is it changing at all over quarters? Like, have they stopped issuing more shares? So guys, on our software, you go to the income statement and you go all the way to the bottom.
Yes.
Yeah, there's a lot more steady now.
Quarters, yeah.
Good. Okay, so it seems like they might be, and they should be. As you're generating more cash flow, you don't need to raise more investor money. Just pump the brakes. Let's see what analysts are saying. Doubling the EPS, which I'm surprised about. It takes 6 years to double EPS, 5 years. I would have thought more.
I would have expected more revenue growth as well.
Yeah.
It's good growth, don't get me wrong, but I would have expected more.
Let's do a stock analyzer tool. When was the last time I did Enphase? I did it. Here we go. 8, 14, and 20% revenue growth for the next 10 years. Profit margin of 15, 20, 25. Free cash flow went 25, 30, 35. P of 13, 16, 19. And desired return of 14, 18, and 22.
Ooh, I beat it up.
You have it higher.
Yeah.
Yeah, guys, I have a price here. I have it on my watch list under $70.
Yeah.
Thank you very much for your time.